Hey there, everyone. Happy Wednesday, January 8th, 2025, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from an actually sunny Redmond, Washington. Sunny days like this are pretty rare, and I'm enjoying it. It's still quite cold and quite wet, but we'll take it. Hope you guys are all doing well wherever you're at, making sense of this kind of choppy, sloppy, sideways day that we saw with the major averages. We're going to talk about the overall market conditions, focus on some of the outliers, stocks actually breaking up, stocks breaking down, and bad news if you run a quantum computing company after comments from NVIDIA's CEO dropping names like Rigetti and others down quite a bit. That is the risk with stocks being bid up aggressively based on the promise of technology, but it's all about speculation of how soon some of these great developments will be here. Is it years from now or is it today? That's what we'll have to continue to assess on some of those growth names. Overall, a lot to talk about. Let's get right to the market recap. And thanks so much, all of you, for tuning in live on Facebook, LinkedIn, YouTube, and X. I appreciate you so much doing so. You can ask questions on any of those platforms. Just put a question in wherever the comments section is on the platform you're on. I can see all of those live as we're doing the show. And if you're watching this on replay on our YouTube channel, just drop a question in the comments section. When we do our all mailbag episode on Friday, I will hope to answer your question live on the air. By the way, tomorrow, of course, markets closed in memory of President Jimmy Carter, which is pretty common when a president passes. They'll have a day closed for trading in recognition of that. We will be doing a special episode of the show around 2 p.m. Eastern Pacific, 5 p.m. Eastern tomorrow. So make sure you tune in as well. All right, looking at the major averages, I mean, ended up being kind of a sideways day for stocks. Some headlines I saw talking about the small cap Russell 2000 nearing correction territory, meaning it's down 10% off the highs. I'm not a huge fan of general labels like 9.8% down is fine, but 10.1% down is all of a sudden a correction and we need to do something differently. I'm much more interested in where we're at relative to key levels and what the trends are represented in the form of moving averages and slopes of indicators and those kind of things that we talk about on the show. However, the truth is there, small caps underperforming large caps here, for much of 2024, but now all of a sudden starting to the new year, you're seeing further weakness in that area of the market. End of the day, though, the S&P, not much change. We're around 59.18. That's up slightly, 0.2% from yesterday. The Nasdaq Composite actually ended up just slightly below yesterday's close, just below 19.4. We'll call it 19.480. The Dow, the best performer here of the U.S.-based indexes, up about 0.25%. Mid-cap's about the same as well. The VIX actually moved slightly lower, not much of a change again. So overall, this is not a big directional move kind of day. This is more of a choppy sideways move. I think, the more interesting data points as I'm looking at the action today, not to get too ahead of ourselves. Number one would be the breadth, which was much more negative than positive. So while the S&P is holding up fine, more stocks were down than up. And I think that's an important data point to remember. Also, Fed minutes from the latest meeting were released, and it showed essentially all of the governors concerned about inflationary pressures with an incoming Trump administration. And I think, between now and the beginning of February, we're going to have a new president in office. We will see what sort of initial policy decisions are sort of forced through the system on a very short time frame, which is what has sort of been threatened. And also the first Fed meeting of the year, most likely no change to the target rate, but obviously a lot of Fed governors concerned about inflation remaining elevated or turning back higher, given some of the inflationary implications of policies that Trump has talked about. So a lot to maybe digest. Overall, the market kind of taking that as a cautionary sign, which is why you're not seeing continued strength in the major averages. But again, no real move today. Today was not a big directional day. Interest rates overall moving slightly higher, not by much. 10-year long bond yields were all slightly higher. The dollar actually moved a little bit to the upside. Looking at the commodity space, some of the bigger moves you'll see are in commodities, with gold up about 0.5%. That's about it. Silver up about 0.25%. Natural gas prices continuing to move higher as well. Cryptocurrency is actually moving quite significantly to the downside, and that is one of the interesting new, themes of the early early readings of 2025. Bitcoin, Ethereum, most of the other major coins tracked here all down today. That has been sort of a new trend, right? I mean, if you think about Q4 and Q3, right? I mean, Bitcoin, Ethereum aggressively moving to the upside. Bitcoin pushing above 100,000 for the first time in history. Now back below 95,000, down another 2.5% today. Ether prices, which bumped up to around 4,000, now down to around 3,300. We talked about Ether, I think, on the show yesterday or Monday. I forget which one, but today we're going to look at the chart of Bitcoin, talk about some potential downside targets given the short-term deterioration that we've certainly started to experience here. Looking at the sectors, you can see that most sectors were actually up today. 8 of the 11 S&P sectors finished in the green. Top performer not up by much, though. The materials and healthcare sectors both up a little more than 0.5%. Real estate was number 3, up 0.4%. I actually had some questions recently about the healthcare sector, so we're going to focus just a little bit in the chart review section on the XLV, and I have one particular name to highlight for you. But I was asked recently whether healthcare is an offensive or defensive sector, and when we get to the chart of the XLV, I'll try to answer that question. The answer is yes and no, a little of both, to be completely honest with you. 3 of the 11 S&P sectors finished in the red. The biggest down today, not much, 0.6% lower for the communication services sector. This has been, I think by any stretch, the top performing sector here in recent months. On a relative basis, the XLC has kind of outpaced everything else. So today you're actually seeing that move a little bit lower. Technology and utilities were essentially flat for the day, but those are number 2 and 3 from the bottom. Keep a wary eye on the market trend model. This is my own market trend model that I've developed over the years as a systematic just check on the market trends, and I update it every Friday after the close. This widget on stockcharts.com looks at a daily check on what the model is telling us, and then again Friday at the close is when I formally make any changes and announce that to my premium members. But I would point that as of today, if today was Friday and this was a wrap for the week, short-term model would be bearish on all time frames. The mid-cap model has been leaning bearish on the medium term, and as of today's close, it looks like the small cap model would turn bearish as well. So the way that a market top would most likely play out, given my experience with a lot of other major market tops, if that's what we're experiencing here, which I'm seeing plenty of signs that tells me that's a possibility. The short-term model turns first, and then the medium-term model, there's enough of a down pull or a pull down to trigger the medium-term model turning negative. And why that's important to me is because the medium-term model based on the S&P is my main kind of risk-on, risk-off model. When that medium-term trend model is bullish, which it was for the entirety of 2024, that tells me to remain essentially fully invested, to be looking for long ideas, to be taking on additional risk, and kind of be happy for that as long as the charts deserve my capital. When the medium-term model turns bearish, that tells me to be more cautious, to focus more on capital preservation versus capital growth, and think more defensively and start to position myself that way as well. So for now, the medium-term model for the S&P remaining bullish, but we'll see what happens. Again, we're closed tomorrow for trading, but Friday, we'll see what happens when we reopen. I mentioned the breadth negative, and actually depends where you look. I should have mentioned that the breadth was more negative for the Nasdaq, and actually look at how this plays out. The Nasdaq composite advanced decliners, about 2-to-1 decliners over advancers. If you look at the S&P's breadth, though, more up than down. And so sort of the further away you were from growth today, the better your breadth probably ended up. Well, that's not entirely true because the small cap S&P 600 is not a particularly growthy index. And that was also, more decliners and advancers. So very much a mixed day across the board, which is very much a sort of treading water, let's wait and see kind of trading day. The Magnificent Seven stocks, of course, super important to track these key names just because there's such a huge weight in the index. And certainly, kind of the theme, if not one of the key themes of 2024 was the continued strength demonstrated by these mega cap growth names. For today, the technology names, particularly Microsoft and Apple, doing okay. Microsoft, the best performer, up about 0.5%. On the downside, Meta was down about 1.2%, followed by Alphabet and Netflix, all in the red today. I did want to point out, by the way, the top performing groups, looking at the Dow industry groups. This is a group of industry groups by Dow Jones, about 106 of them that cover U.S. stocks. the calculation of these indexes is kind of sketchy in my experience. They're price weighted indexes. The members are not particularly clear. It's hard to tell exactly how the indexes are calculated by my estimation. So I'm not as big of a fan of using these all the time. However, for a quick read on what was up or down and what groups were leading or lagging, it's pretty good. Gold miners, your top performing group today, along with non-ferrous metals. So basically a bunch of mining related names in the materials sector getting it done relative to other groups out there. All right, let's look at the market carpet. This is a heat map style visualization. We'll start looking at the overall landscape. And I would say, listen, I mean, generally a flat day, but more positive than negative. You don't see a lot of bright red, but you do see it clustered in a couple key areas. You do see some areas of the market that were actually up fine. But I'm sort of struck by how this was a very neutral day, right? Generally, the biggest names were kind of flat. And that's why the benchmarks did not move a whole lot from Tuesday's close to Wednesday's close because of that. So the overall impression I have is kind of a neutral, quiet day on the markets. In terms of the largest names, which is the second thing that we like to do, looking at the heat map, looking at Apple, Nvidia, Berkshire, Amazon, Tesla, these stocks were essentially unchanged from yesterday's close. So again, kind of a quieter day. I am noticing, again, communication services has been the best sector on a relative basis in recent months. Today, not the strongest by far. Alphabet and Meta both down today. And again, not a ton, but certainly compared to a quiet day elsewhere, that stands out to me. Finally, let's look at some outliers on a quiet day like this, when the market averages were essentially flat. Anything bright green or bright red was doing something different. So I think it's important to sort of check in on those names. In the upper left, you can see in the technology sector, AMD, Micron, both rotating lower. Now, these are names that are actually on the top of the list here earlier in the week as they rallied off of a fairly weak level today, kind of giving back some of those gains from yesterday. So Micron down about 2.5%, AMD down over 4%. I think I grabbed the chart of AMD for the chart review section here in a moment. Looking elsewhere, you can see the renewable energy names, which did get a bit of a contrarian bounce earlier in the week, all giving some of those back. Enphase, Solar Edge, First Solar, all deeply in the red today relative to others. The healthcare sector, I mean, very mixed, right? So you have a Boston Scientific up over 4%, making a new all-time high today. So again, friendly reminder that regardless of what the benchmarks are doing, what I always like to say, some stock somewhere is breaking out. And BSX is your example today, making a new high. But in that same group, you have things like Johnny John down about 2.7%. This has obviously been a weaker part of the healthcare sector. Moderna, which we highlighted yesterday because it had a nice bounce and breaking to a swing high, down about 9% to today. The other one I wanted to mention was some of the red that you see in defensive sectors like consumer staples, utilities. So again, one of the sort of warning signs that I look for, thinking about what we learned with the Hindenburg-Omen firing in December, thinking about what we've observed with breadth and momentum conditions deteriorating, you look for signs that we have a downside follow through. And two general things that fit that bill for me. Number one, does the S&P to the Nasdaq break below short-term support, right? Do they fail to hold their recent lows? Not yet, right? S&P 5850 is still holding as of today. The other thing, do you see enough of an improvement in defensive sectors that implies institutions are rotating to the more defensive side of the ledger? You're not seeing that yet, right? On a day like today, you're seeing a lot of names in those defensive sectors actually going down quite a bit. We're not really seeing the relative strength in those defensive sectors improving to the degree that I would say gives a clear signal of a defensive rotation. For now, I would say it's still in wait and see mode. I do see some questions coming in on a couple different platforms. I appreciate you guys watching live. And again, any questions that come to mind as we're going through the charts here, make sure you drop that in the comments section wherever you're streaming this. We'll take a question or two before we wrap the live stream. And anything we don't get to, we'll put it in our mailbag. And we'll do an all mailbag episode on Friday of this week. We'd love to answer one of your questions in that episode. As we mentioned here in recent days, the daily chart of the S&P, looks toppy, would be my sort of, casual way of what I'm seeing. Now, what is it about this chart that looks toppy? Well, a bull market, according to Charles Dow, turn of the in 19th into the 20th century, said an uptrend is a pattern of higher highs and higher lows. So we simply look for when we stop making higher highs, right? A healthy bull market, we keep making new highs. And during the pullbacks, we keep making higher lows, and that's what continues that uptrend. At some point, a chart no longer makes higher highs and higher lows. An example of what that kind of looks like, look at Palantir, which we've highlighted recently. Look at, BlackRock, some of these stocks, making nice higher highs, and all of a sudden they make a lower high, and all of a sudden they make a lower low. And all of a sudden, that's not an uptrend anymore, right? According to Dow's definition, this is now a downtrend. That's what you're looking for in the S&P. Now, we have made the lower high when we tried to get up to 6,100 and failed to do so, and stalled out around 6,050 and then 66,000 or so. That means we're no longer making higher highs. The question is, do we make a lower low? And that's where 5850, I think, is a pretty important level still to watch. That's where I have an alert set. That's what I'm monitoring, as we've talked about here for quite some time. If and when that is broken, I think it's going to be more when than if. I will certainly let you know. And that's when the topic of that day's show will be downside objectives for the S&P, because we've broken short-term support. For now, as promised, it's holding. So I would consider anything above there more noise than anything. We're sort of in wait and see mode to see if 5850 will hold. For now, it is. Note, by the way, that the momentum is very neutral, right? The RSI is kind of rotating between 40 and 60. This is a market in transition. It's almost like the market is waiting for the new president to be, to be inaugurated, waiting for this next Fed meeting, trying to get some closure on a lot of uncertainty in terms of what a new presidential administration could mean in terms of policy decision, in terms of market implications. So the market is essentially telling you to hold on. As Jesse Livermore famously said, there's time to go long, time to go short, time to go fishing. This is one of those time to go fishing times, according to the charts. Now, as we've covered here, I think on the show pretty closely, even though the major benchmarks are still okay and not breaking down, there are a lot of signs of weakness that we've recognized under the hood. The breadth conditions really started to deteriorate in the fourth quarter of last year, particularly in the month of December. You saw most stocks in the S&P now below their 50-day moving average, almost half of them below their 200-day moving average. That's a sign of a market sort of in a period of weakness. I would also say the volume picture has not been particularly rosy. This is the Chaikin money flow, classic indicator kind of tracking trends in volume that Mark Chaikin developed to improve on sort of the daily look at volume readings. Why don't we look at the volume over time and weight it based on the direction of each trading days to sort of gauge accumulation versus distribution? We can see that that flipped below the zero level third week in December and now remains below that point for now. So previous times when we've gotten below zero and kind of stayed there, July of last year, March into April of last year, these are sort of those pullback phases. And of course, July into August of 2023. So there's periods when we've had corrective moves, when we've given back some of the previous gains in the previous bull cycle. That's where this indicator tends to go negative, because the volume is heavier on the downward pointing days versus the upward pointing days. And so it's suggesting or implying more distribution. So even though the averages are kind of flat here, you can see that the volume picture has rotated from more constructive in early December to now more negative here in early January. So I think the volume and the breadth conditions certainly becoming less positive. This is the McClellan oscillator. And again, this is a sort of traditional measure of short-term breadth. It's based on the slope of the advanced decline line, essentially, as my interview with Tom McClellan highlighted. And again, if you missed that, it was the latest episode of our podcast just before the holidays with Tom McClellan. So you can check that out on my YouTube channel called Market Misbehavior. Really interesting discussion about the origins of the McClellan oscillator, what his parents were thinking when they designed it, and how he uses it in terms of different methodologies. I thought it was a really cool conversation. But the McClellan oscillator, as of yesterday's close, back below zero. Based on what I saw from the breadth conditions, I don't think that's going to change much today, but we'll see once the official close is locked in. But watch that, because the McClellan oscillator was negative for most of December. It did go slightly positive here at the beginning of the year, but now very quickly going back below zero. We talked about Bitcoin and we talked about the chart of Ethereum earlier in the week. Today, I just want to highlight the chart of Bitcoin. Similar to the S&P, it has a very toppy feel. And the reason why the chart looks toppy, if you've looked at a lot of charts, because it looks like a head and shoulders top. It's not a perfect one. I don't think textbooks will include this particular example of a head and shoulders top, but it certainly fits the general criteria. You have a high surrounded by lower highs on the left and the right. you have a pretty clearly defined neckline using the swing lows between those interim high points and the head in the middle. If and when we break below the neckline, which has not quite happened yet by my estimations, currently around 91, 92,000. If we would break below there, that implies a parallel move, whatever the height of that pattern is. We probably have a similar move to the downside. So you think of it as an if-then statement. If we would close below the neckline around 91 to 92,000, that would imply a downside target by my measurement around 77,000 or so. Which would be another, what do we call it? Another 16,000 points below current levels. That's quite a drawdown, of course, from the all-time high around 108,000 that happened just under a month ago in mid-December. I also shared a Fibonacci retracement analysis on this chart. I took the September low because sort of the bottom of this base before the rally phase in the fourth quarter. I took the high from mid-December. 38.2% of the way down would be around 87,000. So that might be another level to watch. A 61.8% retracement would take us down to 74,000, which just happens to be the previous long-term high from March. That actually lined up with the all-time high, the previous all-time high from going back beyond the left side of the viewable area. That was in the mid 70s. We retested that high in March of last year. We pulled back to 50,000 and then broke out to the eventual all-time high around 108. So 61.8% retracement around 74,000. That would be the previous all-time high, a 61.8% retracement, the 200-day moving average, not far from the downside projection based on that head and shoulders top. So I'm starting to key in on a potential downside target that would make sense if we would break down below like 90,000 and complete that rotation. I could see downside as sort of that 73, 74 to 75,000 range, which would be sort of a confluence of support, as we call it. All of these levels lining up here together. First things first, though, we need to break below the neckline. I would also watch the momentum to see if the RSI can hold 40, because that might be a sign that it's not much of a breakdown. But if we break below there, breakdown in price on weaker momentum, that could indicate a further downside target to be considered. One of the things that started to change quite a bit here in the last couple months has been the strength of the dollar. I think part of that means, U.S. markets over non-U.S. markets, clearly still a theme that has been in place for, pretty much all of 2024, I think still holds true. But also the stronger dollar can start to weigh on multinationals, some of the mega cap names that have a lot of non-U.S. revenues. That's a very real risk. And we'll see as the first earnings season of the year kicks off here in about a week. We'll see how much companies are talking about the strength in the dollar and how that potentially could influence non-U.S. earnings. But again, look back to 2022 for an example of what can happen when the dollar is so strong and kind of everything else rotates lower. Crude oil prices actually starting to improve as well. So even the dollar is strengthening. A lot of people kind of think, well, if the dollar is so strong, commodities can't be so strong because they're denominated in dollars. But it doesn't always play out that way. The dollar can rally along with crude oil, along with gold and other commodities. Generally speaking, there's kind of an inverse relationship, but not always. And you can see here that the dollar and crude oil have actually been pretty closely positively correlated for the last year and a half. And overall, we're starting to see crude oil potentially emerge from a consolidation phase here. I think still more to, more to prove for energy stocks to be a great potential technical bet, but overall strength in crude oil is something to watch. All right, we'll finish off looking at some individual names, and I'll take a couple questions here before we close the market recap show today. Palo Alto Networks, obviously one of the technology names that had done quite well for much of 2024. Going into the holidays, however, started to look a lot less ideal. This is one of the many names showing that bearish momentum divergence. And when you ask me why sort of I have a more cautious tone as I'm reviewing the charts here in recent weeks, I would tell you it's because one of the key check marks on my market trend, my market top checklist, would be a proliferation of bearish momentum divergences. Often at the end of a bull market, you'll find stocks still going up, but on weaker momentum. We've highlighted that with Palantir, with BlackRock. Now I'll highlight it with PANW, Palo Alto Networks. You can see the momentum divergence with higher highs into December, weaker momentum. Now all of a sudden the momentum has gotten a lot less ideal. The RSI has gotten all the way down to oversold levels. It hasn't been all the way down there since February of 2024, when we actually successfully tested the 200-day moving average. You can see a number of times where PANW has tested the 200-day moving average. We haven't had a big break below there since back in 2022 off the left side of the chart. So as of today, you're seeing buyers come in as we test the 200-day, still down about a point, 1.5% from yesterday's close, but rallying, traded below the 200-day, but found some support there. If we would break the 200-day on weaker momentum, and this looks like a pretty ugly chart all of a sudden. We've already broken the 50-day. I would say in the short term, the trend is clearly down. The fact that the momentum's even getting down to that level is kind of a concerning thing. But something like this, where I find the stock has held the 200-day many, many times, I'm wondering if that's going to happen again. And if not, that's where you start to think about further downside projections based on the framework of the uptrend, maybe using Fibonacci retracements as a good starting point. AMD and other semiconductors, we've talked about the semiconductor space, the SMH, and looking for a potential breakout above resistance. It's not quite done so. And names like AMD, probably some of the more frustrating charts within the semiconductor space. The AMD is bouncing off of support around 120. That was the low from mid-December. We retested that low right around New Year's, and now we're right back to that level. We are below 2 downward sloping moving averages. So overall, I think this is a bearish chart on its surface, right? Because we're making lower lows. We're below 2 downward sloping moving averages. The RSI is consistently below 50. So I get interested in a name when those things are no longer the case. I like stocks that are no longer below 2 downward sloping moving averages, where the RSI is breaking above 50 and even 60, signifying an influx of momentum, and where the relative strength is starting to improve. None of those things are true about AMD right about now. This is a stock making lower lows and lower highs below 2 downward sloping moving averages. I think this is a wait patiently for signs of accumulation kind of chart. There are some stocks that are actually breaking out. I will highlight a couple. eBay making a new high today, up almost 10% today. It was up a little further today, almost made it to $72 a share. Did settle down and close just below $70. But I would say overall, this is a nice breakout above previous resistance. The previous high, just about 67, was back here in October. We had a big gap lower around earnings, but you can see that gap was bought, right? And I think that's why this is a kind of an interesting chart. Anytime we have a big gap, which prepare for that, right? Because around earnings, you'll often get a quick gap higher or lower around earnings. For me, it's all about what happens after the gap. It can be very difficult to predict that eBay is going to have a tough earnings result and that the price is going to gap lower to the degree that it did. But we can then look to see what happens next, right? Do investors continue to sell? And after that gap lower, they're just thrilled to get out of the way and limit their losses? Or do you see buyers come in? And that is what we saw with the case of eBay. We gapped lower, but all of a sudden that gap was bought, and you saw the gap was quickly closed within a week. We're right back up to $62 a share. From there, we're starting to make higher highs and higher lows. And today, we're gapping even further to the upside. So pretty constructive recovery after that gap lower in October. And again, that's why we look to see what happens right after gaps. Gaps down that are bought are often pretty encouraging signs. Boston Scientific, BSX, another one making a new all-time high today. Ended the day right around $96 a share, just slightly below that. That's up about 4.5%, 4% from yesterday's close. We are overbought, but that doesn't concern me a lot, because in consistent uptrend markets, you will often get overbought and you will stay there. Look at how much Boston Scientific has been overbought since the beginning of 2024. It's happened a bunch of times. What's even better is when we've pulled back, the RSI has never really gotten below 40. So that is an example of where a chart is just in a firmly bullish range. We're above upward sloping moving averages. The momentum is in a constructive configuration. These are the types of charts, generally speaking, I'd look to buy on pullbacks, right? Buy the pullbacks to the 50-day, buy when the RSI pulls back to 40, and ride that next wave higher. For now, BSX kind of doing it. Now, what about healthcare as a broader bet? Not a great opportunity. And I will tell you, this is a chart that I include at the end of my monthly chart review, which I just did earlier this week for my market misbehavior premium members. When we look at the monthly chart review, one of the things we do is look at a weekly chart of the 11 S&P sectors, and we focus on relative performance. This top data series is the relative strength of the XLV versus the SPY from the end of 2022. That was 2023. This was 2024. Look at the consistent underperformance. And just with a couple random exceptions, like during the pullback in July and August of last year, overall, this has been a sector that's been a chronic underperformer. So sectors that continue to underperform are the type of sectors I don't prefer to own, because as I was taught, if you want to outperform the S&P 500, you need to own things that are outperforming the S&P 500. And thanks to my friend and fellow Stock Charts contributor Tom Bowley for that one, which I love quoting because I think it's absolutely spot on. There's benefits to owning things that are outperforming. So while BSX as a stock is outperforming the benchmark, the XLV, the sector as a whole, nowhere near as good. Now, going into this year, you're seeing a little bit of an outperformance. And if you look at the daily chart of the XLV, you see a bit of an improvement to the relative strength, but the longer term theme has still been so negative. So on sectors like that, sectors like energy, I still think much more to prove until you think of really rotating as more of a sector play. I think it's more opportunistic on the charts that are working in that sector. CPAY, CPAY is a name you may or may not be familiar with. This is a large cap name in the consumer finance space. The reason why I wanted to highlight this one, nice bounce off of support. So, the bull case, I would say, I mean, when you look at how the charts like Palantir and others and BlackRock have had these really good runs, and I think, excuse me, CPAY had a similar move from a June low to a high in late November. It then pulled back, and we broke below the previous swing low. We broke below the 50-day moving average. When you start to see that kind of breakdown, I immediately think about Fibonacci retracements to identify a potential downside target. Now that I know the trend is lower, where might I expect some sort of support, some buyers to come in? 38.2% of the way down to that June low is right around 332. We can see that line up really well with where we hit in mid-late December. And from there, we're starting to bounce back to the upside above the 50-day moving average today, up about 2.8%. So stocks holding that first Fibonacci support level, kind of interesting. As long as that holds, I think that could be a good opportunity to get back in and ride the leg higher. But what happens if we would eventually break below like 330? All of a sudden, this looks like a head and shoulders top, and that would be breaking the neckline. So right now, sort of an interesting time to see if that support will hold. For now, it certainly appears like it's doing so. All right, that is it for our chart review. Excuse me. Sorry, I'm still kind of struggling with the cold here, but good enough to do the show, which is good. Let's take a question or two. And again, thanks so much, all of you tuning in live on these different platforms. I can't see the questions you put in. Anything we don't answer, we'll put in the mailbag. Planning an all mailbag episode for Friday, and I'll hope to answer your question on the show. Especial, I'm assuming your name's Al, and you're capitalizing the A&L, and I love that if that's true. What is your opinion of the Fear and Greed Index? I appreciate you asking about this. Fear and Greed Index, I'm assuming you mean the CNN Fear and Greed Index. I don't have a problem with that. I actually like it. What that is, if you have followed my work and if you followed some of the interviews that I've done on my podcast last year, one of my early episodes, I interviewed John Kosar of Asbury Research. He has a model called the Asbury 6, which is a kind of macro model. It combines some price momentum, some price breadth, some fund flows and other things, volatility. If I remember, I might be making that one up, but it combines a couple different things and sort of aggregates them all into a general market trend, right? So instead of looking at a model based purely on price momentum, which is what I tend to do, they incorporate some other things too into one master score. And the idea is, how bullish or bearish is the market based on all these traditional things? That's an example. The CNN Fear and Greed Index, kind of a similar thing. I mean, it looks at breadth, it looks at momentum, it looks at volatility, it looks at a couple other things. I think it's 6 or 7 different items. Last time I checked, it was down on the fear side of the ledger, and I'm assuming that's based on some of the things we've talked about, right? Breadth deteriorating, momentum certainly deteriorating. I would say volatility is probably not that bad, but other things clearly getting bad enough to tip it to the fear category. I don't have a problem with that. I like that sort of thing. To be honest with you, one of the things on the many things on my rainy day list of cool things to do for market misbehavior, my own operation is to create my own market misbehavior kind of market gauge type of thing. But boy, I haven't gotten to it yet. So yeah, I would say those things are fairly helpful. What I've seen, I looked at it earlier today as an example. I would say it is demonstrating a rotation from greed to fear, and what we've talked about in terms of deteriorating breadth and momentum. Some of the breakdowns that we've observed, I think, are what are causing that index to rotate more to the fear side, and I think that's exactly how this market feels. So I don't have a problem with that at all. I would say, though, the most important thing of anything would be trend, right? And whether we think the market is greedy or fearful is much less important than whether the market is going up or going down. So that's why I focus my number one question on that. Let's see. There we go. Charles, thanks for watching on YouTube. I'd like to know the difference between supply and demand and support and resistance. Really interesting question. That could be actually the subject of a whole hour-long webcast. Maybe I'll work that up at some point and do it. I appreciate asking that question. You know, I mean, to be honest with you, I would say those words like that are used in some cases interchangeably. I mean, when I think about supply and demand, I'm thinking more of the sort of actual participants in the market, and the more people want to own things or not own things, right? And when you think about the supply into market, how many shares outstanding there are, and the demand, how much people want to own something or not, I would argue that price is a great representation of that interplay between supply and demand. Now, support and resistance are really a technical defined phenomenon, and a resistance level is kind of a ceiling on the market, a level above which we're unable to go for some particular reason. A support level would be a floor in the market, right? A level below which we're unable to go. Now, I have heard different market practitioners, peers of mine in the industry, refer to those as, demand areas and supply areas, implying that when we get to an upper end of the range, that's a supply zone or a supply area, because that's where there's probably going to be some selling, which means putting supply into the market kind of thing. And I get that. I don't really refer to things that way, but I get the argument there. So I would say supply and demand just really refers to the action that is probably being taken to cause prices to go up or go down. And I often get people with a follow-up question, if I would answer something like that, saying, well, how can the supply chain change? Because if a bunch of people want to buy stuff, someone else has to sell it. And you're right, but it's more about investors. And if we all want to buy something, some broker is going to be forced to sell it to us and take a hit. That's what market makers are eventually there to do, is basically be the last line of defense. And if no one's available to sell, they just start selling stock to make sure that the markets are still liquid. So it really is, I would argue, the idea of supply and demand makes sense in the markets. And if more people want to buy than sell, if more people want to own a stock than not own a stock, the price is going to go up. And it's similar to any other kind of good or service out there in the market. That's it for now. And listen, I appreciate some of the other questions. We don't have time to get to all of them, but I'm going to put some of these really good ones into the mailbag episode, which we will be airing on Friday of this week. As a reminder, tomorrow, the markets are closed in memory of President Jimmy Carter. We will be doing an episode, probably a special episode. I was actually thinking of some New Year's resolutions for investors. It might be the angle that I go with. We'll see what I come up with tomorrow when I think about it a little bit further. But don't forget to tune in tomorrow. Even though the markets are closed, we'll share some ideas with you and keep you thinking to continue on this week. Folks, thanks so much for joining me today. Excuse me. Sorry for the coughs, and thanks for hanging with me as I struggle through a cold, but I appreciate you listening to me and following my charts and following my work. For Market Misbehavior, I'm Dave Keller. Have a great night. And remember, it's always a good time to own good charts. Take care, folks.